Hi, everyone, and welcome back to Forcing Markets. This is our financial markets podcast. I have with me today my co host, Serhii, and today we're going to be talking about how assets behave during volatile times of war and also why some assets are performing better than others. Specifically, some ETFs are performing much better than the entire market. Serhii, if you could introduce yourself, please.
Yes, hello everyone. My name is Serhii. I'm very glad to co-host this series. And today, I think Alejandro, we have pretty interesting topic to discuss. I have had a look at your portfolio, and it's pretty interesting. So it behaves like I didn't expect it to behave. And today it will be really interesting to dive deep why exactly this is happening, like why the things that we have selected, which are safe things under understanding of the war context, why they are outperforming so much the Standard and Poor's.
Yeah, and one of the things that we're going to be discussing is correlation and inverse correlation. And the reason why I want to bring this up early is because we're going to be looking at how this portfolio that we created approximately a week ago when everything started has been behaving against the overall market. Excuse me. So with that in mind, I'm gonna go ahead and share my screen and basically show what we've been observing during this time, right? So this is when theory and application kind of meet each other. So our theory a week ago was that we were going to create a safe assets portfolio, one which would track raw material directly, right? So think about if we go back in history when we had the gold rush, the people who were making the majority of the money were the ones who were providing the tools to everyone else who was going out to look for gold, right? Looking for gold was, very risky. But if you were selling the pickaxes, then you had, people coming in and buying from you. But the biggest winners were not just the ones who were selling the pickaxes. They were also the ones who had the metal to create the pickaxes and the wood to create the handles. So that's why currently what we're seeing in the market is something that is very, very similar. And when we were talking about inverse correlation, as you see here, the S&P 500 has been dropping over the last month. And if we look at it over the last 5 days, which is when we see the majority of issues happening, this is counter to what happens in the S&P 500. So the blue line represents our safe assets portfolio and the yellow line represents the S&P 500. As you notice, whenever the S&P 500 drops, this portfolio goes up instantly. And whenever the S&P 500 is going up, this safe assets portfolio drops. So
Also, we have like mathematical anti-correlation scenario.
yeah, we have exactly. So we have mathematical anticorrelation, and that's what we're going to be discussing today. Is why is it that they are behaving so opposite to each other, and how long are we going to continue to hold this portfolio? So from a mathematical point of view, Serhii, since math is your strong suit, maybe you can tell us a little bit more about correlation before we jump onto the 5 topics we will talk about today.
Yes, so basically, correlation, it's a phenomenon when, for example, you have two assets and if they behave like similarly, so you can say about like positive correlation. So it can be like from 0 to 1. This means like if one, they are ideally go like show the same trajectory. But if you are talking about anti-correlation, so basically this is like -1. So this means exactly the same pictures that we see on Alejandro's screen. So when one asset goes up, exactly at the same point, another asset go down. So this is a linear dependency between uh, various time series. So it can be assets, it can be like portfolio values, it can be like value of some compound fund, and so on and so forth.
So if we think about that, right, the S&P 500 is made of the top 500 companies. That's why you have the Standard and Poor's 500, and then that basically means that the Fortune 500 companies, I'm not sure if all of them are in the S&P 500, but I would imagine the majority of them are within the S&P 500. So all these companies that have all the money right now, they are not necessarily behaving in the way that you would expect it to behave during normal times. So one of the things that we need to try to understand is why do commodity futures outperform when supply shock hits? And so what happens is that when a supply shock hits global markets, like wars or sanctions or disruptions to shipping routes, the immediate impact is suddenly a shortage of physical goods like oil and wheat or metals. And because of that, then the commodity futures react very quickly to the shortages because they represent the market expectations of future supply and demand. So, as traders anticipate tighter inventory and higher replacement cost, future prices often rise very sharply. This means that the inventory holding commodities, futures, or funds that track them can benefit directly from the price spike. But unlike many other assets, commodities are tied to the real physical constraint. So when supply is restricted and demand remains steady, futures markets will adjust rapidly upward to reflect the imbalance. What that means is that if you own the physical commodity, all of the sudden that commodity is harder to come by in other places and you can charge more money for it. If you have futures that are directly tied to it, then those futures are becoming more valuable. And in this case, if you have ETFs that represent those futures, those prices for these commodities that you're holding are going to go up much faster than the actual companies that need those commodities to do the work, right? Because they have overhead costs if there's restrictions in the supply of oil, or if fuel prices go up, they're going to have greater overhead costs, which means that their overall profitability is going to drop.
So basically, this is like standard economics, right? So when you have oil, everything runs on like oil. If oil goes up, so this means that there is a shortage. So at the same time, it will trigger the prices for the foods because it needs to be transported and so on. So the forth. So it's like basic economics, how everything is tied together. You just need to track these dependencies, right? How also goods are produced and so on and so forth. And that's it,
Yeah,
correct?
right, exactly. And that's basically what I wanted to discuss today is that if you want to create yourself a portfolio that is going to perform better during times of war until everything becomes, normal again, then these are some of the assets that you could look into that would probably perform better than the market as a whole, right? So, what is the difference between owning a commodity or owning a commodity company? So, when you own a commodity, uh, that basically means that you have you have the raw material. But if you own a commodity company that produces the commodities, that's a very, very different investment. Because when you buy the commodity, like through futures or ETFs, then you're gaining exposure directly to the price of the raw material, such as oil or wheat. In contrast, if you own the commodity company, that means that you are investing in the business with operating costs and management decisions and debt levels and political risk that can affect profitability. So, for example, if oil prices rise sharply, an oil producer may still struggle in its extraction cost because now they may have disruption during production days, right? So one day they may be pulling oil from the ground, but then the next day they may not be able to because people were not able to come to work because there was just no way to get through the roads due to the war effort. So these are very, very real things happening in the market. So because of
Yeah.
this, the commodity uh, company stocks often behave more like equities than commodities themselves. So normally under normal times, the commodity companies they reflect what is happening to the commodity. So if the price goes up, the commodity company that will be selling this commodity will be able to gain larger revenue. But during times of war, they may not be able to do as much with that same commodity or be able to extract that commodity. And because of that, their price will drop, even though the commodity is going up in price. So
And how
while
strongly are they correlated at all?
uh,
Take like only commodity and at the same time like so it's companies that owns that probably
yeah, I
create
mean that's
commodity within this infrastructure. So how's the infrastructure impacts?
so this is okay. So
Is it
this
like
is like
strong
the
impact or it's
so this is U.S. oil fund, and this is what we're looking into. But let's say that we were going to compare this with like Exxon Mobil, which is an energy company. So if you look at Exxon, we see here that or actually let's compare here directly. Exxon. So if we compare the two, you see, while the oil has been going up, Exxon has just been trailing. Like it's not moving as quickly. So if we look at what's happened over the last 5 days, we see that the oil itself has been very volatile, while Exxon has been very, very stable. There's like not a lot of variability on it. But if we notice, ExxonMobil is mostly down um, this entire time, right? If you look at the lower curve here. So if we follow it, we see that even though we were making good profits with USO, Exxon was losing money. And then what happened here is that for anyone who's familiar with this, uh, the IEA, which is one of the um, groups that is able to release oil, release first like 70 million barrels, and then they release another 400 million barrels to absorb the shock. So that extra supply of petroleum made the cost of USOs to drop. But if we see here, Exxon still did not perform. Exxon did not start performing until basically today, where it seems like the market has absorbed a lot of the different things that are happening in the war, right? So this is
Mhm.
how they compare. Although the commodity is going up in price, the company that would help extract that commodity from the ground is not performing as well. But if we look over a period of 1 year, you see they usually perform very correlatedly as what
Mhm.
um Serhii was explaining earlier, right? Almost one to
So
one.
oil goes up and Exxon goes
And
up.
Exxon goes up.
Because now
But in this,
during the war, it's become
yeah,
anti-correlated,
they become anti-correlated in the war.
poorly correlated. Yes. Yeah. And again, like another question is still like how oil supply disruptions actually create a negative correlation with the Standard and Poor's as well. So why Standard and Poor's like does not buy oil and does not like put it in their portfolio? So why
Um,
do we see this anti-correlation?
so when we're looking at this anti-correlation here between the two, that's because when investors are trying to move their money, there is investors are gonna try to put their money where their models are gonna tell them that they need to be putting their money into, right? So let's say that you have a set of institutional investors that are holding the assets that they're already looking at because they have a long-term horizon. So for them, their algorithms that they're using are already absorbing these particular shocks in the economy. So for them, they're not very interested in taking their money out and taking the risk of putting it in the direct commodities, because if there's no shortage of that commodity, then the price is very quickly to react and to drop. Like you see here, within 1 day from March 9th to March 10th, like literally 1 day, this went from having a 6% gain to a -3 drop. That is a drop in 1 day of 10%, right? Absolute value 10% drop from six.
Mhm.
While if you're looking at the S&P 500, it actually didn't have that kind of shock. So if we look here, the S&P 500 was at -1%. And then here, when everything dropped, the S&P 500 went to +1. So the difference between the two is about 3%, right? So that's why if you have long-term investments, they're going to be looking at this and they're basically going to try to absorb this volatility. But that creates an anti-correlation between the two, like a negative correlation. Because as soon as the commodity drops in price, that means that the very thing that was causing the market to move either up or down, there's now more supply of that. So because there's more supply, the demand hasn't changed. Then given the loss of supply and demand, when there's more supply of oil, the prices for oil will drop, and the overhead cost for these very companies within the S&P 500 is also expected to drop. So that's why they behave in a way that is opposite to each other, and it's really just related to what is their cost of operation, how much profit are these companies going to be able to keep, While if you are holding the future directly, there's now an oversupply of oil. So that means that the futures that you're holding are going to become less valuable. So because those futures are becoming less valuable, your prices are going to drop. But at the same time, the price of the companies that make up the S&P 500, their cost is also going to drop. So their overall worth or their overall revenues is going to go up. So that's why you see this negative correlation between the two. Does that explain it?
Yeah, it's
Uh,
pretty interesting.
Okay, so now we've explained like what's the difference between owning a commodity and owning the commodity company. So now what we're going to talk about is how oil supply disruptions create negative correlation in the S&P 500, which is what we were discussing earlier. So basically, when you have oil supply disruptions that create negative correlation between energy prices and the broader stock market, the oil prices surge due to geopolitical tensions or production cuts, and energy costs rise for business and consumers across the economy. So higher fuel and transportation costs will squeeze corporate profit margins and reduce consumer spending power, which can pressure point or can put pressure on the stock prices, right? So they will drive it down because there's less money to be spent. At the same time, oil related assets and commodity funds often rise because the underlying resource becomes more valuable. And so this is what we're seeing with the direct exposure to all of these ETFs. So because the cost of production for this is increasing, the companies that will produce this, their value, becomes less, or the amount that that companies are willing to put into these companies is going to drop, which means that the stock price is going to go down, but the commodities themselves will go up. So that's basically what we're seeing here. That is what it is explained through the graphs that we're seeing. And so this dynamic means that during supply shocks, oil and commodity assets may move upwards while the S&P 500 declines, which is literally what we have seen here. And this creates a temporary negative correlation between the energy markets and the broader equity market. And that's basically what we've been looking into. So we created this portfolio on March 2nd when everything happened, and we went ahead and we bought directly into the ETFs that represent the commodities. And the outcome of that is that we created a portfolio that has now grown by 12.5%, while the S&P 500 has dropped, right? So if we look at the overall for the last month, basically, we see that this portfolio has grown by 13.04%, while the S&P 500 has dropped by 1.89%. So we are outperforming the market with this particular portfolio.
Can we remind our viewers what else is in our portfolio? And probably go one by one in more detail.
Sure.
What is it?
Okay. Yeah, that's fine. So we're going to start with the United States Oil Fund. So the USO is an exchange traded fund, and it is designed to track the price movements of crude oil through future contracts. So instead of owning the physical oil, the fund holds oil futures and reflects expectations of oil prices in the market. So a future is a contract that says you are going to either buy the oil at a certain price on a future date, or you're going to sell the oil for a certain price in a future date, right? So if you are holding this future, you are entitled to this raw good, and in this case, is oil, which means that this future contract can now be sold for a higher price because people are expecting that they're not going to be able to find oil as easily as they once did. So this is one of the assets that we're holding. If we look at the GS at the GSG commodity index, so this is a broad commodity ETF that tracks the S&P, GSCI, Goldman Sachs Commodity Index, which includes a diversified basket of commodities such as oil, natural gas, metals, and agricultural products. So because energy commodities carry large weight in the index, oil prices often have strong influence on the fund performance. So people who own GSG gain for exposure to overall commodity markets rather than betting on a single resource. So, in periods of inflation, supply shocks, or geopolitical tension, these diversified commodity funds like GSG often perform better because many materials will rise in price. And because this is holding a lot of oil, it is also expected to go up in price, right? And if we look at it, that is exactly what it has done. From the time that we bought this portfolio till now, it has grown by 24%. And this
Yeah,
is
it correlates with the oil
correct.
very, very good. So it's like
Correct.
almost the price because
Exactly.
of oil.
Exactly. So now if we look at optimum yield diversified commodity, so this strategy basically is a diversified commodity ETF that provides exposure to future contracts across energy metals and agricultural commodities. The key feature is that it avoids issuing a K1 tax form. So this is basically related to taxes, which means it is simpler for investors from a tax reporting perspective compared with some commodity funds. The fund actively manages its future contracts to reduce negative impact of future raw costs because it spreads exposure across many commodities. So as we see here, this one has also increased by 20.13% over the last month. And
So
so,
basically, this is like easier entry for investors because you're not do not have to have these taxes for trading of this commodity, right? And
yeah,
this is why
exactly.
like growing so much.
And that's exactly what it is.
What is like K1 form? Can you like give a hint?
K1 is related to taxes, so this would be more like for a certified public accountant. I know that like the K1 form is a tax form that is issued, but this is more related to the commodity traders, the people who actually hold the futures. So long story short, this reduces administrative costs, right? So when you hold an ETF, one of the things that you want to look into is what is the administrative cost. So by having a simpler way to perform your taxes, you're going to reduce your cost in administration. That's
That is
basically it.
interesting.
Yeah. So then the next thing that we're going to be looking at is wheat. This is one of the other assets that we have in our portfolio. So wheat is a specialized commodity ETF that tracks the price of wheat future contracts. Because wheat is a critical global food staple, the price can be heavily influenced by weather conditions, geopolitical conflict, um, export restrictions, and agricultural supply disruptions. So when the harvest fails or major production countries face disruptions, wheat can rise very, very quickly. So this asset, this ETF, allows investors to gain exposure. So if you're expecting that there will be a shortage in the food supply, wheat is a very good asset to get into because it will rise and fall with the expectation of shortages, right? So how does that translate into what
So
we're looking at?
basically, this is like due to the supply chain disruptions, right? In the Gulf, which
Exactly.
tankers cannot go, and so on and so forth.
Yeah.
So this is mainly because this kind of disruptions.
Well, and if we just look at it from a very practical perspective, let's say that you are a farmer who has wheat and you need to get wheat from one country to another, but now oil prices are going to go up, right? So you have a contract to sell wheat at a certain price, and now you are holding the future of that contract. So, so what this means is that if this particular farmer can now get the wheat to where they want to go, there will be a shortage of that commodity. And now, if you hold a future that says that someone will provide you this wheat, regardless of what happens around the world, then you now have a guarantee that the amount of wheat that is necessary will be delivered. So that future will go up in price. So exposure to the CTF will be directly correlated to the supply of wheat. That's basically what this
So on
is
one side,
showing.
there is like supply and transportation. If it's like disrupted, another is like the cost of this transportation because of the oil price going up. So the fuel will go up. So on and so forth, correct? So this is
Exactly,
Kashachi. And
exactly.
the futures, so we will have like separate episode where we will go into depths how exactly this works for to understand better this mechanics.
Yeah, exactly. And so PBDC and DVC are very similar. So the difference between the two is that DVC tracks a rule-based index of major commodities, which include oil, natural gas, gold, aluminum, and agricultural products. But the fund uses future contracts to mirror the performance of this commodity basket. So energy commodities tend to dominate how this fund performs, just like on the PDBC. And so when oil and gas has a lot of movement, this will significantly impact this index tracking fund. So what we gain from here is that there's multiple ways to invest. Basically, you can either do this one, which is helping you with or helping the future with their taxes, or we can go with this one, which has nothing to do with taxes, and as you can see, gives you greater returns. So if we look at PDVC, it's 17.04, and over time, like over 1 month, the total gain is 10.94%. But if we look at DVC, uh, over time, it has a greater price, and then the total gain is 10.67. So very, very, very similar, right? This is what we're seeing between the two. So you can either do one or the other, you'll get the same exposure. The only difference really is the entry price point. One you enter for 28.57, while the other one you enter for 17.05. And I think that this is something that we discussed on our previous episode where we were talking about the safe assets, that both of these give you very, very similar exposure. But psychologically, you may look at one and think, well, I can buy more shares of one versus another. So if you want to get something for a lower price, even though you're expected to get the same returns, you can enter between either one or the other. The next asset that we're going to be talking about is corn, right? So how does this Tilcrum Corn Fund work? So corn is another agricultural commodity ETF that focuses specifically on corn future contracts. Corn is widely used for food production, livestock feed, and ethanol fuel. So its price is influenced both by agriculture and energy markets. Weather events, planting conditions, biofuel demand, and global supply shortages can drive corn prices higher. Investors use corn to gain targeted exposure to agricultural commodities that may benefit from supply disruptions or rising demand for biofuels. So since we know that oil is currently in short supply because of what's happening in Hormuz and with Iran, biofuels become more valuable. So this is going to cause corn to go up, as well as the food disruptions that we have seen.
So
The
basically,
next,
like multiple effects at the same time, right? The same effects that go with wheat, and assuming that this is also like connection to the energy market, so it's also the impact the energy markets as well,
yeah,
like chain
exactly.
reaction.
So it is a chain reaction that is going to have a domino effect where all of these things are happening on the background, and that is affecting the futures market. So futures are going to go up in price, and because corn has direct exposure to agriculture as well as energy, then this is expected to be positively affected, right? While everything else is going down, corn is very likely to go up. So the next one is the DBA Agriculture Fund. Again, this is agriculture and it has to do with supply shortages. So this is a very diversified agriculture ETF that holds future contracts across several agriculture commodities such as corn, wheat, soybeans, sugar, and livestock. So you can either get direct exposure to wheat or you can diversify by utilizing the DB Agriculture Fund, and then this will give you exposure to all of them. So how does that work? Uh, Overall, well, because this does not give you direct exposure to any one single asset, and it is more diversified, then it is expected to have less volatility. So over the same period, this has gone from 25.89 to 26.76. So about, according to this, 3%. But if we look at corn, we're looking at 5.73% gain. And if we look at wheat, we're looking at a 7.87%. So this tells us that the commodity that is expected to have the largest shortage is also going to have the largest gain of price in the futures that is sold. Okay, and then this one is the 1 to 3 month T-bill ETF. So this is one that does this seesaw type of interaction. What you want to do with this one is you want to enter very, very early, and you want to make sure that you exit right when this hits the peak, right? So in this case, we entered on March 3rd, and we're gonna exit at the end of the month. So the very last day of the week, that's when we're gonna exit this. Why is that? Because we are not expecting this to give us more than a 0.3% gain. And if we hold it past the end of the month, that gain is gonna drop, you know? So so Bill, which is this one, that's the code for a BIL. It's a short-term U.S. Treasury bill with maturities between 1 and 3 months. These securities are backed by the U.S. government and are considered among the safest financial instruments available. The ETF is often used as cash equivalent or capital preservation tool while still earning a small amount of interest during periods of market volatility or uncertainty. But if we see here, like you'll notice that this was at the low end 91.54, and here at the low end is 91.40. And then here at the high end it was 91.73, and here is 91.62. So why do we have this very slight drop? Well, it's because the US dollar has lost value compared to other basket of currencies. So because of that, if you're looking at exposing yourself directly to currency and you're betting on the US dollar, if you buy this directly, you're still going to get your return, but the overall value of the currency has dropped. So that's why the overall value of the T bill has dropped as well. So when you're looking at that, that basically explains why this is happening.
And this was it like New Year event where the basically price dropped lower than the average low? Or
Yeah.
December 17. Oh, okay. And why was it
Yeah.
December 17 before?
So this basically, we would have to look at what happened in December 17th. So it either happened because it was the closing date for accounting, or a major event would have taken place. So what we would have to do is we would have to look at the news from December 18th to try to see what that happened. And I don't have the information for that. But we can answer that on the next episode. But it would either be an accounting reason, or it would be that a major event happened on December 18th, which caused the overall value of the US dollar to drop. I don't recall anything of major, newsworthy value happening on December 18th. At least, I don't recall it. So I would have to look at the news and see if something happened, or if this was simply because of year end in accounting that everyone was closing and selling, and that causes the value to drop at expiration. So remember, this also happens when the T bill expires or mature. They don't actually expire; they mature. Okay. So what does that mean on what we have here for our safe assets? As long as we continue to have a war effort happening in Iran and the Hormuz Strait is blocked, we will continue to see oil disruptions, and those oil disruptions will continue to make scarcity, and that scarcity is going to force futures to be traded for a higher price, which will make these ETFs become more valuable. And that is what we had for today.
Nice. Shall we also talk about like recognizing the commodity shock regime in financial markets? What do you think?
Um, yeah, so we can talk about that for a bit. So let's go ahead and just discuss what that means. So when we're designing algorithms that detect trade and macro regime shifts, the algorithms are designed to trade macro regime shifts that focus on identifying changes in the underlying drivers of the market rather than predicted short-term price movements. So instead of relying solely on technical indicators, these systems analyze relationship between asset classes such as commodities, bonds, equities, and currencies to detect when market behavior begins to change. For example, a sudden surge in commodity prices combined with rising volatility and weakening equity indexes may signal the beginning of a supply driven regime. Once detected, the algorithm can shift capital towards assets historically associated with that environment, such as commodity funds, energy ETFs, or defensive instruments. By recognizing these transitions early, systematic strategies attempt to position portfolios ahead of major macroeconomic shifts. So this is basically what we did here. As soon as, but we didn't really actually use an algorithm for this. We just kind of use common sense. Um, and we said if there's going to be supply shortages in oil, we're going to put our money on commodities because those commodities are going to be directly affected by the shortages. But an algorithm
Yeah,
would have
but
been able to detect the same thing.
do you know any kind of automated systems that have been used for this, like probably by other trading firms? What do you
Yeah.
think? And how often they do it? Like how often these shifts happen? Is it like half a year periods or always like weekly periods?
So a lot of these institutions, they have their own systems in place to find these kinds of shifts, and you have very specialized individuals who are able to write and proceed with this system so that they can move assets. Um, so if you have short-term traders, so people who are looking at a 1 month or a 3 month horizon, these are the individuals who are going to be looking at these algorithms, and these algorithms usually tend to be internal, so that the people who are in places like Goldman Sachs, for example, they would be able to look at these regimes and determine that because we are expecting a supply shortage, they're going to use their own internal algorithms to determine whether or not something should be bought. So one that would be like really interesting to look into, let's see if I can remember the link, is going to be Varans. So if we look at Varans and we're going to look at USO, so I haven't actually looked at this, but let's see what they're saying here. So they are saying that the yield for this is unknown and that the net expense ratio is 0.83 and that the turnover is not applicable at this particular moment in time, right? But like, let's say what they tell us about Exxon. I think that's the right. No, I I think I might have to actually search for it because I don't remember the. Let's see here, Exxon. Exxon is XOM. So let's see, Exxon. Okay, so if we look at this one, they're saying that you should sell, right? It has been downgraded to hold on November 24th. And then they're saying that the average price is over. So that means that they are expecting it to grow higher. But at this moment, they're basically say that they should sell this stock. So
This is interesting.
yeah, so this tells us that Byron's algorithm has not been updated to compensate for what is happening right now. So why is that? Well, because it's been a week, right? And these algorithms usually need to consume more information before they can catch up to what's happening in the market. So the algorithms that
Basically, the major shift has happened in the fundamental structure of the market, but they're still like reliant on old data and old parameters that are governing their dynamics.
yeah, I mean they have
Basically,
this
still trying to reason in the previous understanding.
yeah, and so in order for me to see a stock radar, I would need to log into the system. But what does that tell us about the algorithms that institutions are using at the moment? So if this is any kind of barometer to let us understand what the institutions are doing, the institutions are still trying to see what's going to happen. And while they're waiting, because they're expecting this to be a very short-lived war, we're getting disruptions in the market. Futures are going up, and the ETFs that will expose you directly to futures are also going up in price. The lesson to take from this is that any kind of investment you do should have a trail stop loss. And we have discussed this so many times in our episodes. If you don't put a trail stop loss on your portfolio, you're going to be exposed to all the volatility that happens because of world events. But if you put a stop loss on your portfolio and you don't put emotion into it, but instead you just think of it systematically, once the stock exits your portfolio, try to understand why it exited and try to see if it's worth going back into the same stock, or if you want to buy something within the same sector, or if that sector is dropping as a whole. So that is basically the lesson that we are learning here. The algorithms that are designed um, to try to catch this volatility, they haven't had enough time to catch up with the information. So we need to use a little bit of common sense when we're looking at these kinds of things. If a certain asset is going to have shortage, then the commodity for that asset is going to become more valuable. So the future that guarantees delivery of that commodity will also become more valuable, which is why we invested on all these ETFs.
This is really interesting.
Okay. Glad that glad that I was able to bring up a very interesting topic today.
Yes, yes, because like we're literally building this model of interactions and causal loops that drives the economics, and you're compiling this literally in your head and trying to reason with this knowledge. And so this is really cool. So
Yeah.
otherwise, yeah, definitely will need like to write a huge number of equations to model all of this in the right way.
Right. And that's basically what sets experience apart from theory. Like we talked about this multiple times. Experience and application just it basically reminds me of the things that I have faced before and what I've seen. And I'm using that knowledge to build these portfolios and then see how they perform, and try to later on explain it with mathematics that can go back, look at the historical things that happen, and then say, well, this theory, right? Because what I have now is a theory, has proven right, or this theory has proven incorrectly. So this is when we take experience and we bring it to theory to try to explain mathematically what's happening in the market.
Yep. And at the same time, you're like flexible when you see like some orange swan event. So basically, you can literally sleep it in your head and calculate the outcomes and understand like how to adopt immediately. Because otherwise, if it's like hard-coded algorithm, it will take time for programmers at least at first to understand like what went wrong, and second to fix it in the code and in the model itself. And then
Yeah.
you need to test it probably to understand its statistical behavior, and only then you will be able to deploy it. So that things which will take time, a lot of time.
And that's exactly what we're trying to explain in the show. So we leave you all with this information. There are assets out there that you can put your money towards. If you want to get access to this particular portfolio we have described in here, send us a comment and we will just put it on the comment page so that you guys can have access to it and you see how it's performing. And with that, we leave you for today. See you all next time.